Hey there, smart investors, and welcome back to the channel where we dive deep into the fascinating worlds of hard-to-borrow stocks and potential short squeeze setups. Today, we're looking at a company that's popped up on our screen with some seriously eye-watering borrowing fees. But before we get into the specifics, a quick but crucial reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about the Growhub Limited, trading under the ticker TGHL. This company operates in the technology and software infrastructure sector, specifically as an investment holding company offering product traceability, data analytics, and product trading facilitation solutions primarily in Singapore and internationally. With a market cap of $26.03 million, TGHL is definitely on the smaller end of the spectrum. It's a company focused on helping businesses track products from raw materials to final production, which is a pretty vital service in today's supply chain environment. So why did TGHL grab our attention? It's all about one key metric, its cost to borrow. What is cost to borrow and why it matters? For those new to the game, cost to borrow, or CTB, is the annualized fee short sellers pay to borrow shares of a stock so they can sell them, hoping to buy them back later at a lower price and profit from the difference. When a stock becomes hard to borrow, it means there's a limited supply of shares available for shorting, and demand from short sellers is high. This scarcity drives up the borrowing fee. These fees can, and often do, exceed 100% annualized. Imagine paying 100%, 200%, or even higher just to hold a short position for a year. It adds significant pressure to short sellers who need the stock to drop quickly and substantially to turn a profit. Why the stock is hard to borrow right now. Now let's get specific with TGHL. This stock appeared on our hard to borrow screener because its annualized cost to borrow fee is a staggering 773.1%. Highlight number, that's not a typo, over 773%. This tells us there's an incredibly high demand to short TGHL, or a very, very limited supply of shares available to borrow. Unfortunately, the exact number of shares currently available to borrow is unknown at this moment, and we don't have data on CTB momentum for TGHL today. However, with an estimated float of 12.7 million shares, if a significant portion of those are already shorted or unavailable, it creates a tight situation. Our internal composite squeeze score for TGHL sits at 46.5 out of 100, indicating some interesting dynamics. Looking at recent price action, TGHL is down 7.14% today, but zoomed out, it's actually up 3.48% over the last 5 days and a whopping 73.33% over the last 30 days. Chart of 30 DAY performance, the kind of run-up often attracts short interest. However, today's volume is notably low at just 377,400 shares, a fraction of its 30-day average volume of over 10 million shares, giving it a relative volume of 0x average. Squeeze mechanics explained. So, how does a short squeeze happen? When a stock is hard to borrow and its price starts to rise unexpectedly, short sellers begin to panic. They are obligated to return the borrowed shares at some point. To do this, they have to buy them back in the open market. If many short sellers are trying to buy back at the same time, it creates a cascade. This buying pressure drives the price even higher, forcing more short sellers to cover, and the cycle continues. It's like a coil spring: the higher the cost to borrow and the fewer shares available, the tighter the spring. Dilution risk check. One critical factor to consider with any potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can significantly offset or even negate a short squeeze thesis because it provides more liquidity to the market, making it easier for short sellers to find shares to cover, and it reduces the scarcity that drives up borrowing fees. For TGHL, we've done our checks and found no recent dilutive SEC filings such as -1s, -3s, or 424Bs in the last 90 days. This is generally a positive sign for a short squeeze scenario, as it means the company isn't immediately flooding the market with new shares. Again, it's absolutely essential to remember our disclaimer as you evaluate any investment. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. A high cost to borrow like TGHL's 773.1% is a red flag for short sellers, but it doesn't guarantee a squeeze. Sometimes, a high CTB simply means that short sellers have strong conviction that the stock is headed lower, and they're willing to pay dearly to maintain their positions. So, what should you watch for with TGHL? Keep an eye on the supply of shares available to borrow. Shrinking supply is a key indicator. Watch for increases in volume, especially on green days, which could signal short covering. A consistent rise in price combined with a continuously high or increasing CTB and decrease in borrowable shares is the recipe. The 73.33% gain over the last 30 days clearly shows a strong move for TGHL, but today's low relative volume and price pullback also remind us that these situations are fluid. The Grow Hub Limited, TGHL, presents an intriguing setup with its extraordinary 773.1% cost to borrow fee and recent upward momentum. While the lack of immediate dilution risk is a positive, the low relative volume and the nature of short interest mean careful monitoring is key. Remember, this is about education, understanding the mechanics of the market, and learning to identify setups. Do your homework. Research TGHL thoroughly, understand its business model, and look at the broader market context. If you found this breakdown helpful, please smash that like button, subscribe for more unique stock analysis, and let us know in the comments what stocks you're watching right now. We love hearing from you. Thanks for tuning in, and happy trading.